We're going to talk about a very simple strategy, the theory behind it. It's called a range deviation strategy. So there's something that's required, quite obviously, and that's a range, and that we need a deviation of the range. This is a very high probability trade, and it revolves around market structure. It makes it a little bit easier to call it a strategy, however. So as you can see, I have drawn up the contents of how this strategy were to play out. So we have a low, we have a swing high being formed, we have the equilibrium of the range, therefore confirming the range. After the confirmation of the range itself, what I'm looking at is, depending on, first of all, which direction the range came from. If I pulled my swing low before my swing high, then obviously I want to watch the structure that forms from the high all the way down to wherever it deviates that swing low of the range. That's why in this example here, I have drawn out the internal structure. And that internal structure is a lower low, a lower high. Price came down and formed a lower low, a lower high, and a lower low. So what we're looking for is we're looking for a SFP, or swing failure pattern / deviation of the previous swing low. In this case here, we have that. We have the deviation. As you can see, there's a wick in there. So if I were to move this over, see, we have a wick. That told me that the range has deviated. Therefore, there could be potential trapped traders within that wick. Smart money may be using those trapped traders to get into long positions. Maybe is a bad word to use. So in saying that, we need confirmation. So how do we confirm a range deviation trade? We watch the internal market structure from the high to that low break internally. If that structure is to break internally with a significant break in structure, as I have indicated here, there is a very high possibility upon a retrace into the new demand range, because this is now a internal demand range in green. Okay, this is now a demand range. Upon mitigating that demand range, in theory, this becomes a weak targeted level, the swing high of the range. So that would be my overall target. With this strategy, depending on the size of the range, like if it's a larger range and we're talking $500, $600, $700 plus on Bitcoin, you may want to consider taking off half of your trade at the midpoint of that range. So for the most part, I won't deny that unless I think it's going to really run, like we're talking that this could very well be a significant bottom on whatever asset that I'm trading, I generally take off 50% here and 50% here, leaving me with a 3 risk reward or 3% gain. Meaning that if I risk 1% on my stop loss, I'm making at least 3% on the high. And that's, of course, estimating that the stop loss would be a little bit lower than the range low, right? Just to give it a little bit of extra room. If you were to plan the trade, most of the time, that's what it ends up being. But so what we're looking at here, again, it's quite simple. We have a swing low that formed. We had a swing high that formed in a range. We're watching for the internal market structure to shift from the high down to wherever price deviates. And once we have that, following the next internal break of structure, and that's a requirement, you have to have the internal break of structure. If there is no structure, it is riskier. Can you still make your way up from this low or the deviation low towards the high without this internal shift? It is possible. Sometimes that market structure, maybe it doesn't shift until way up here. Perhaps this area doesn't exist. What if you had a situation like this, where you had this downwards move, yet on that downwards move, you had this for structure. It was just a down, up, and then down for the deviation, where you investigated this leg and there was still no structure. It's just all bearish candles. Well, in that case, it's definitely a riskier trade to just assume that this is now a weak high based on this wick alone. So you have to be careful with that. Very, very careful with that. What you can do, though, again, is you can go down to a lower time frame. This is all that you've seen. Let's pretend that you had down, up, and down, and that this little squared off area was actually a lower time frame structure area contained within this leg. So again, that's fine, but your target isn't necessarily the range high upon a shift in structure because of that logic. Your target would be this high. So what I mean by that is, and we'll go to the drawing board here. So let's say we had ourselves a range, right? You have a swing low of a range, we have a swing high of a range, and then we have the midpoint of that range. And we'll call it a 15-minute range. So we have a 15-minute range. Now, let's say that within that 50-minute range, there was no structure that you noticed on the deviation, at least not on the 15, right? And then you went down to a lower time frame and you said, well, geez, I'm going to investigate the leg between here and here because there's nothing here in the 15. And you ended up going to the 5 and you've seen this, you've seen that, and then you've seen this. And I'll use a different color so you guys can see this. I'll use red. So we'll call this a 5-minute lower low, a 5-minute lower high, and a 5-minute lower low where the deviation of the larger 50-minute range actually occurred. Okay, that's fine. But the problem remains that price has to come all the way up to premium pricing still of this range, meaning that you have to get a bullish move up to here and just hope that it's going to retrace to get into a long all the way up towards that high again. That's kind of silly, right? That's kind of silly. So in saying that, what we could do is we could investigate it a little bit further, meaning that we can use the fractal structure of this internal structure and go to the 2-minute time frame. If we went down to the 2, maybe we had down, up, down, up, down. And I'll use purple to represent 2-minute structure. So if we were to get a 2-minute break in structure and a retest, let's say we actually get that. Let's say we get a 2-minute break of structure. We got the retest of the newly formed demand range following the break, and we entered on the retest. We entered right on the top of it. We put our stop right on the bottom of it, and now we're targeting up to here. This is technically incorrect. Even though, yes, you had the break in structure, this is technically an incorrect target per se, even though, yes, this is a range deviation. Can you still get this? Yes, you can. But technically speaking, to get this, you need to wait for this guy to break, right? Remember that. So breaking this high, the 2-minute high leads to the 5-minute lower high. Breaking the 5-minute lower high would therefore lead to the range high, okay? You have to follow the motion. Every time you dissect a leg of structure, your target becomes less and less and less until you see more evidence, okay? You have to remember that. And this is all based on the advanced market structure in the order flow series. Watch it again if you don't understand this. So that's a key criteria. Another thing that we have to be careful of whenever playing range deviations is the following. Let's say that we have a range being formed, the exact same range, 15-minute lower low, 15-minute lower high. You got your 15-minute confirmation, all is well. Okay, you got your range. There you go. Perfect. Let's say that it deviated the high first, and then comes back within. You may be inclined to think that this is the automatic target, right? But in reality, that's not the case. That's not the case. Even on 15-minute structure, that's not the case. We're going to pretend that this was actually 15-minute market structure, yet it was such a big move that it actually gave you 15-minute internal structure within this leg. We'll say that this is the actual 15-minute internal structure here. We use orange. So we're still in the same time frame. It just so happens that we're able to draw multiple structure drawings on the same time frame. Okay, fine. That's perfectly fine. And we actually had that 15-minute internal break, okay, or the fractal break on the 15. So when we had that fractal break on the 15, you would think that, oh, wow, that's enough to justify a short all the way down to here because Phoenix taught me that's how range deviations work. When you rotate one side, you go to the other side. Yes and no. Not always. Key criteria is that you have to watch your market structure rules as well. And what does market structure tell us? So the job of this low is to take out the high that created it, which is that high. If it fails to take that, and let's say we only have a wick, and we'll pretend that was a wick here, then the job of that low fails. Therefore, that low becomes a weak targeted low. Not this low. This low created this high. This low created that high. This low created that high. It's always left to right, okay, when you're looking at it that way. Which is why it's always more difficult to look at ranges when it deviates in a downwards trend, it deviates the high prior to the low, or vice versa. In an upwards trend, it deviates the low before the high. It's always better and easier on the head when it goes the other way. But do we have a choice in the matter? No, we do not. We're trading whatever way the order flow is presented to us. It's not like we have the choice on which ones are going to happen here or wherever. Can we only trade the ones that are the easier ones? Yeah, we can do that. But this is still tradable. I wouldn't pass up on an opportunity like this. Okay, I would still trade it for what it is. I would just be more reasonable with my targets because I know that this internal structure is pointing up. So why would you assume that it has to break? Okay. It very well could continue on its merry way upwards. So how do you know in a situation like this, using what we know regarding market structure, order flow, and advanced market structure, how do we know if this is going to happen where it makes these continued higher highs and higher lows and this isn't actually the range at all? Well, we know that because we would watch this, if we were to get into that trade, let's say we got into this trade, I'll continue on with the orange drawing. You got your retest from the new supply range, price continues down. If you follow through with that drawing and then you see a shift in structure on that drawing, we should probably use red here because you can't really see it too well. But if you get that shift in structure within that drawing, like so, well, then we know that, the high is now weak again. So this is now a weak high all over again. And therefore, I would just close my short trade. That's it. This is probably not the true swing low and the true swing high of the range. I would then draw my range high up a little bit further, and I would draw it up to this high and just wait to see what happens from there on out. So just make sure that you guys are watching these things because, yes, it can really impact how these range deviation trades go. Sometimes you get lucky. You just get a standard range, very, very simple. And when I say standard range, I mean during an uptrend, you have your swing high that formed, you have your swing low that formed, you take the high. Within that move, you had this very basic, we'll call this 15 structure. You had your 5-minute structure pointing up, 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 and then all of a sudden it breaks down. And then you get that beautiful retest off the newly formed supply range. This is the ideal deviation. So you have the ideal approach, and then it comes into this red box here, which is the short box. And then all of a sudden, we know that the stop goes above the high, and that we start tackling down towards that weak low. This is now the weak low, and this is nothing but a wick, according to your 5-minute structure. You got a wick and you got a candle. And then all of a sudden, it just continuously goes down, and you win your trade, and you're like, bang, all is well. That's an ideal deviation. But guess what? Again, we don't always get ideal deviation, so we have to be prepared for that. So this is the theory behind how a range deviation works and the various ways to trade it. That's it. There's nothing more to it. If you can get this part down, what I just taught you guys in less than 15 minutes, then that's it, right? You can go all out. You can just trade this from now on. These are very high probability trades because you're trading with smart money. You're not trading against them. You're trading with them by waiting for these structure rules. And again, it's all based on market structure. If you were to hide this range, technically speaking, it is market structure, nothing more, nothing less, except the range makes it easier to understand. Once you see that, you're going to be like, oh, wow, really, it's that easy. But yes, everything that I've taught in the order flow and the advanced market structure series is a requirement before you start touching these things. Otherwise, you're going to get smacked silly. I can promise you that. You need to understand the framework behind these various levels of structure, the primary, the swing, which is the same thing, essentially, the internal and the fractal. You need to understand that. The next video will be actual examples of how I trade deviations using the same theory that we just talked about.